everyone. Welcome to the next installment of Charts and Perspective, where we use charts to dive into the world of economics and financial markets. I'm Jennifer Nass, an economic and market research analyst for TMX Verified. Today, we're going to examine the federal funds rate and review the Fed's latest meeting. The federal funds rate is the overnight interest rate banks charge each other for borrowing. Set by the Federal Reserve's FOMC, which meets 8 times a year, it's a core tool for monetary policy, profoundly influencing economic activity. When this rate shifts, it directly affects borrowing costs for consumers, like mortgages and credit cards, and businesses, and ripples through financial markets, impacting everything from bond yields to stock performance. The FOMC concluded its 5th meeting of 2025 by keeping the federal funds rate in the range of 4.25 to 4.5% as expected. Marking the 5th straight meeting, the Fed has left rates unchanged. While this move was widely anticipated, there were still several important takeaways from the meeting. From the press release, the committee believes that growth of economic activity moderated in the first half of the year, that the labor market remains solid, noting the low unemployment rate, but that inflation remains somewhat elevated, as well as uncertainty about the economic outlook. The Fed reiterated they'll keep a close eye on the incoming economic data, staying true to their dual mandate of maximum employment and price stability, and is attentive to the risk on both sides. This chart here attempts to visualize the Fed's dual mandate by overlaying the Fed funds rate with the unemployment rate and the two main measures of inflation, the CPI and the PCE price index. The Fed aggressively raised rates starting in 2022 in response to decades-high inflation. As a result, inflation cooled, while the unemployment rate remained near one of the lowest levels in history. Then, from August 2023 to September 2024, the Fed held rates between 5.25 and 5.5%, the highest level in over 20 years. Meanwhile, inflation continued to cool, but at a much slower pace, and the unemployment rate held mostly steady, shifting slightly higher to just above 4%, but still at historically low levels. The Fed then implemented 3 consecutive rate cuts to bring the FFR to its current range of 4.25 to 4.5%. Inflation has proved sticky though, and the Fed still views it as somewhat elevated. However, they stated in their press release their strong commitment to returning it to its 2% objective. So what's next for the Fed funds rate? The CME FedWatch tool estimates the probability of future interest rate moves. It's updated in real time in response to economic data releases, Fed statements, and market movements. This chart here shows the tool shortly after the Fed's latest meeting. At the time, markets were expecting 2 25 basis point cuts in 2025, coming at the September and December meetings, with an additional 2 in 2026. Note, however, that since this tool is updated in real time, expectations are constantly shifting and will likely be different, even if it's just slightly, by the time this video is released. Now, the latest meeting was not one in which the FOMC released their dot plot, which reveals individual members' projections of the Fed funds rate. However, I've included it here as a quick reference because it's an important tool providing insight into what individual committee members are thinking. The latest dot plot from their June meeting shows that the Fed projects 2 25 basis point cuts in 2025 and 1 in 2026. But the dots clearly show that there are mixed views within the committee, with 7 members previously projecting no rate cuts for 2025 and 2 members projecting just 1. But just like the CME FedWatch tool, these projections are not set in stone and have likely shifted since its release. The Fed is set to meet again September 16th through the 17th, where the next dot plot will also be released. That's all for our discussion. Thank you for tuning in. For more economic and market insights, you can find my content regularly on the Advisor Perspectives website under the AP Chart section.